Well, welcome everybody. We'll get started now. So today we're going to talk about ring fencing rental losses and what you need to do. And I am concerned about this, which is why we do want to go onto this topic. So I've got extensive experience, as you can probably tell by the colour of my hair, accountant in public practice, but particular expertise in tax, trusts, structuring and business development. And regrettably, as with everything these days, you can't get by without the disclaimer, which says you need to come and ask for specific advice. So while we're going to tell you what we think is reliable, you've got to check it in relation to your own particular circumstances. Now, bit of history lesson. Back in 1982, when Rob Muldoon was Minister of Finance, there was ring fencing of tax losses. And that year, it was limited to $10,000. So if you had a tax loss of $100,000 or $1 million, all you were able to claim was $10,000. And that was initially relating to farms. So the Featherston Street farmer who had a stake in some farm somewhere to offset against his professional income or salary income, he was then only able to claim $10,000 of that loss, and the balance of that loss was carried forward. That also related to rental properties. Now, in 1990, that was stopped, but again, a bit like what is proposed here, it was done on a transitional basis. So they said, right, okay, you can claim your losses as you go from now on, plus $10,000 per year from the past, until you basically use those losses up. Now, I didn't pick this up when the Labour Party policy came out, but they had a section called Cracking Down on Speculators. And so everyone here who's got a rental property, you're one of these people who are being targeted by this as a speculator. Now, in that fine print, which seemed to be more about actually people who are buying houses, flicking them on, making a gain, we want to get some money out of that, that actually they were going to target people who were claiming rental losses against other income. So that fitted within that. And they said in their manifesto that this would be phased in over 5 years, starting from the 1st of April 2019, which is getting closer. Following that, the election of the Labour government, Labour-led government, the IRD put out an issues paper, and often issues papers many pages long, but set out the options the way the IRD felt that this could be implemented, and put that out for public consultation. One option, instead of a 5-year phase-in period, was a 3-year phase-in period. And you say, oh, help, that's a bit scary. Still be from 1 April 2019. The first affected year, therefore, would be the tax year ended 31 March 2020. And the IRD sought feedback on that and all the other detail that was in their issues paper by the 11th of May 2018. We're now 6 and a bit months past that, and both the IRD and the Minister of Revenue, Stuart Nash, neither of them are prepared to say when a decision is going to be taken to move it forward to the next stage, which is unhelpful where you, as a owner of a rental property, need to make decisions on an ongoing basis. You might need to restructure, you might need to change things, you might need to spend money, or you may need to sell before this comes into being. Now, to be effective from the 1st of April 2019, the law could be changed as later as the 29th of March 2019, which is a Friday. Strange, isn't it? Last year, the changes that affected tax were on the 28th of March, I think, which was Easter Thursday. So But time is not on your side. And the risks, as I see it, are that the election policy is very clear-cut. You are deemed to be a speculator in the eyes of the policy, and we are going to do something about it. And we are determined to do something about it, and I think it actually will happen. The only issue is whether it could be left because of other things, so many things happening. It could be delayed for a year, which is a possibility. And the other risk is that it could be done over 3 years and not 5 years. So the effect would be much greater. Not great news, but uncertain. Now, each of you will have a number of individual factors that will come into your decision making as to what you do about this. What is the level of your annual loss at the moment? If it's $2,000 a year, it's not going to matter too much. If it's $50,000 a year, it's going to matter a great deal. How much debt do you have? Do you have the ability maybe to reduce some debt? What is the fixed rate terms of your existing loans? You know, if you're committed for 2 years or 5 years, started and there's still 4 years to go, changing something is going to have a cost. What maintenance are you going to have to do over the next, say, 5 years? The schedule maintenance, replace the roof, paint the outside, paint the inside, the things that are going to happen and you're going to have to do those. You may be thinking, okay, we perhaps need to look at doing that sooner. Maybe before the end of March 2019, for example. And there's not a lot of time to do some of those major things. Rental reviews. You might say, well, if I'm losing $10,000 a year, maybe I need to put the rent up $200 a week. That won't be something that the Labor policy would have contemplated, but it might be that actually, if there's less rental properties, that landlords might have more power to push rents up and say, well, actually, it's going to cost me money and I can't claim it. Maybe I have to make it break even. That's not going to be a popular idea, but it could be an option, or at least move towards that. There are increased obligations on landlords. Insulation, no having to pay the rental fee to rent to new tenants instead of the tenant paying that. And that is probably the thin edge of the wedge. So you say, well, actually, do I want to be doing this? Then you have a clever accountant, as you do. You then say, what can we do to restructure? Because it may be that if I've got a business and I've got debt, I can actually transfer the debt to my other business activities so that actually the rental then stands alone and becomes cash flow neutral or positive, and the losses and the interest costs are somewhere else. Can't be done in all cases, but it can be done in some. If you sell, you may have been owning the property since before 2011, when depreciation on buildings stopped. So you might have some depreciation to recover if you sell. So if you sell, there might be a negative thing. But on the other hand, it might be that actually that offsets your loss, and maybe the timing of that, when you do that, could be important. What's the market going to be for property, rental properties? Is it, you know, at the moment there's quite a bit of negative sentiment around saying that property values might start to fall. So maybe, is property still a good thing to do? Personal goals. Do you want to be managing rental property? Is this part of your passive income for retirement? We know you're going to retire. Is this going to be part of it? Or is this just a hassle and actually now's the time to pull the plug and get out of it? Put my money into the stock market and watch it go like this. All of those factors will come into it, but some will affect you and some won't. Then outside all of that, you've got the Bright Line test. Now the Bright Line test is something that was dreamed up back in the national government days, where it said that if you own a property other than the main house that you live in, and you sell it within 2 years of when you bought it, you're going to pay tax on the gain. And if you make a loss, of course, you can carry that loss forward, but you can't offset it against anything. That was changed March last year to 5 years. So restructuring of property ownership means that if you restructure and say, right, I'm going to move it from a company to a trust, that starts the 5-year process. And the scary bit about that as well is that it potentially covers your batch. There's been a little bit of coverage on the batch tax as well. So Brightline test clearly covers rental properties. So if you sell within, if you bought it before March, 28th of March 2018, you got 2 years. If you bought it after that, you have to hold it for 5 years, otherwise you're going to pay tax on the gain. Now, another thing the Labor government did was to bring in a tax working group to think up new creative ways to tax you, as if there aren't already enough areas of worry. So, the big things, is there going to be a capital gains tax? And you have to say that Labor went back to Michael Cullen and gave him a nod and a wink and said, we want you to cover that in the final report. That actually, that's, we think you guys speculating are making money and these poor people down the bottom are not, and that's unfair. So we want something done about that. Now, it could instead be what you call a deemed income. So you say you've got a property that's not the house that you live in, that's worth $500,000. We're going to say that's worth $10,000 a year and you pay tax on $10,000 a year, even if you make a loss, even if it's your batch. Now, at that level, we all know that the batch isn't going to get through. That's not going to happen, but it could happen on rental properties. So it isn't just about paying tax on the gain, it is possibly paying a deemed rate of income based on the value of your rental property. Then you have the other complication, the person who has the weekend batch at the beach, Martinborough or somewhere, and says, well, actually, most of the time I'm not going to be there. I'm going to be there some of the time. The rest of the time I'm going to rent it, particularly in Martinborough, Toast Martinborough, or something like that, or the beach, you know, the high return parts of the year. So they've already dealt with that in terms of the way you can claim deductions on that, so that there's not going to be much loss left at the end of the day by the time you've done all of that. Then you have the other new complication, the Airbnb. And I haven't actually seen one that's been caught, but I was talking to somebody the other day, and this person had a client who was earning $90,000 a year on their Airbnb. You say, no, as soon as you're over $60,000 a year, it's subject to GST. Not only that, it makes the property subject to GST as well. So when you come to sell the property, you pay tax, GST on the sale of the property. You say, what? This is only... No, this is business. So there are some implications that you just have to think through in terms of some of that. So this is all out to one side on top of the main part of what we're talking about. I don't know what the tax working group's going to come back with, but they are going to come back with something. But hopefully, like every other tax committee that's been there in the past, they will say it's too complicated, and actually the cost of compliance, both at the government IRD end and for accountants and taxpayers, is just not worth it. Why would we create another 500 pages of the Tax Act to deal with something else that's actually meant to be revenue neutral? Okay, so what can you do about it? Something is going to change. Schedule maintenance, you anticipate that. You do it now rather than do it later. Now, if you can't do it before the end of March 2019, that's not going to be the end of the world, because you'll still be able to claim most of it in the next year. If it's over 5 years, you still get 80% of it. If it's over 3 years, 2/3 of it. So that's near enough to most of it. Look at paying down loans. If you've got money sitting in a savings account, $100,000 sitting in a savings account, now's the time to think about, should I pay some of that off in April 2019? Reduce the debt. Interest rates are incredibly low at the moment. Currently 3.9, between 3.9 and 4 you can get for some terms. So maybe if you're going to keep the rental property, look at locking in a lower rate. Restructure your loans between your business and the rental property company entity and say, right, okay, we're going to have the loans out here and claim them, in the rental property we are going to have break-even situation. Increase your rent or sell one or more of your rental properties so that you get back to break-even or better. Is that all making sense? You're not all looking glazed but worried? So I thought, okay, how do we just an actual example of saying, okay, somebody with $2.5 million worth of property, other assets, bank loans are 2.3. They were lucky because they got in before the LVR requirements that said they had to have a higher percentage. Topped up with shareholder loans and minimal equity. So in effect, what they do is they pay off the bank loans, or they move the bank loans to another entity. It's replaced by bigger loans from the shareholders, and you eliminate interest within this scenario on $2.3 million. So that makes a big change to the loss. Probably more than enough to bring it back into profit. But you have to have another entity that enables that to happen. And the numbers, of course, can be much smaller than that and still be worthwhile. Does that make sense? You have to have another entity that's making profits,
Right.
that is going to be able to absorb the interest on the 2.3 million against that,
Yep.
and therefore it will pay less tax because its profit is less.
Yep.
But if your other entity is a trust that has no income or owns the family home, that's not going to do it.
So what sort of entity would that be?
It doesn't really matter, but typically it'll be a company, but it could be a trust. It could be a trust that owned property, that was doing a trading trust that's doing some sort of business activity. But typically it will be a business running a business. So you just have the liabilities in the business rather than in the rental property. Because effectively the shareholders are paying off the loans. The loans are then become a liability in the other entity, and they've refinanced their loans in the other entity by $2.3 million. So it's ended up with them.
So it's shareholder equity.
In a way, yeah. Yep. It's making that number bigger and that number smaller, and the opposite happens in the other entity. Yeah. If it works in your situation, we'll make it sure that it can work and that it does work. Now I just thought I'd put some numbers up here just on a typical rental property scenario. Somebody renting $500 a week with some interest and some other expenses typically would make a loss of about $9,000 a year. This is just on one property. Now if the change happens from 1 April 19 and it's spread over 5 years, the year 2020 you would claim 80% of your loss, which is the 7,200, and that would mean you would carry for 1,800. The next year you would only be able to claim 60% of the loss. Now I've assumed the loss just stays constant through that time, and you'd then be carrying forward 3,600, but a total cumulative carry forward of 1,800 plus 3,600. So at the end of 2024 you claim nothing, and all of the loss will be carried forward. So cumulatively, at that point, based on 9,000 a year, you're carrying forward 27.
So what happens to that at the end of the day?
Okay, there's only two ways you can use that loss. One is to offset, well, effectively to offset it against rental income. So this has to, the 9,000 has to become positive, at which point it starts eating this up. Now, one of the other main ways it could be recovered is if you do have depreciation on the building written off pre-March 2011, that could be offset against this. So you could say, I'm going to get rid of my rental property at some point, and that could be then offset against a number in this column. And if that number is large and this number is large, it might then be neutral. But you still have to have rental income, and if you never have rental income and you died, if it was personally owned, that would be down the tube. But you do, to get it back, you do have to have positive rental income. Or the law has to change, or you have to vote national. I didn't actually put that on the law. So if it's 3 years, then there's more drastic action or that needed and needs to be done earlier. So while you're thinking about it, you say, okay, most rental properties in this situation are held through LTCs, but not all. So let's just say, okay, they are LTCs. Does that mean that LTCs are finished? What happens if somebody today says, my wife and I are living in this house and actually we want to get a different house, but we'd like to keep our own one as a rental? Is it still worth doing the LTC? We sell the existing house to the LTC for market value, borrow as much as we can against that. The answer is yes, because it's still going to save you money. Not as much as it did, and some of it is going to be carried forward, but it is still worth looking at that as an option. If I buy another rental property with borrowed money, should I do it through an LTC? Should I do it through family trust? That point you have to look at what's the outcome, the profit you need to, so you have to predict the rental income, the expenses, is it going to be a loss or a profit? If it's a small loss or a profit, then you probably say family trust. If it's a large loss, then you're probably still saying LTC. What should I now do if my LTC is making a profit? As some people are now moving into. Maybe it is now time to wind up the LTC and move it into a trust. Or sell the shares in the LTC to the trust and then wind it up. To reduce the number of entities that you have. But that requires some calculations to see, and the depreciation recovered may be a factor in that. And that's the last one as well. So what you all have to do is develop a plan. You have to consider your own situation and your priorities. You know, if you're retiring next year and your income is going to go down, you might say, well, I've got some depreciation recovered, potential liability there. Maybe I time that to when I've got only New Zealand super income. So the tax rate on that, it's low. Get some advice. Decide what are important factors to you. Many people have been buying rental properties because they said, right, I need to have passive income in my retirement. When I wake up in the morning, the rental income is going to keep rolling in, and that's going to help fund whatever I want to do. Go surfing, go cruising, go whatever. Hang gliding, whatever you do at age 65. Then you have to implement it. Or the last option, of course, is you do nothing in what I call the ostrich syndrome. You hope for the best. I don't think that is an option. I think you have to plan. All right, so we're going to have some questions in a moment. Those are the areas of things that we do. And my contact, and Julie's if you want to ask her afterwards for a copy of the slides we've covered. Now, I haven't tried to cover everything. I've tried to cover enough of it to say, right, okay, what are the main areas that you need to think about? Thank you, everybody, for coming. If you want to come back to us afterwards, by all means, flick Julie an email, flick me, contact us. We'd be happy to talk further about anything that you didn't understand. If we didn't make it understandable, that's our fault. We'll do our best afterwards to do that. Thank you for coming. So now we can have questions. I think the tax working group itself will probably come out with something that might be unworkable. And if they were, because they've got some experts in it, they'll probably say, well, actually, if they really wrote what they really thought, they would come up with nothing probably. And so we've thought of all of these things and actually we cross them all out. But I think they're under political pressure to deliver something. Well, I suppose historically looking at our clients who have been involved in rental properties, it is about an element of saving for retirement. It's diversification from investing in the stock market, and it is about buying passive rental income on the long term. And it might be that the goal was to get 2 rental properties or 10 or whatever, and at the point of retirement you'd say, right, well, let's, if necessary, we sell 1 or 2 to eliminate the debt, and it then rolls on. So it was never intended to be temporary. But you're right in terms of actually if you're dealing through property management companies, then it is actually easy to squeeze, because in a way they've already done a bit of that by saying actually they all need to have health and safety, all the people who work for them and doing their electrical work and whatever, and actually if they don't, they're not going to work for them. So we end up paying gold-plated prices for everything that's done through the... But the other bit that's interesting, if capital gains tax covers everything, it's then going to hit KiwiSaver. And so, okay, how politically acceptable is that going to be? And the other bit, of course, is that this is going to come in after the next election. So who's going to vote Labour if something unattractive comes up? I mean, not that at the moment there isn't a great alternative probably, but you're saying, okay. So it might be that actually this might be the thing that undoes Labour, because that's the thing that they failed to get elected on a couple of times in the past. So it starts to have lots of political repercussions. If National come back, it's hard to believe it's going to happen in a wide-scale capital gains. It's going to be more like the Bright Line test. We're going to pick at a few things that are going to give us political mileage that actually have the nature of capital gains tax, but without, giving room for the longer term investor not to be caught out. But you just think, do you want... Capital gains tax is very complicated. Do we want another whole army of tax people? Not really. But that might be enough, as you say, the accidental landlord is saying, actually, let's get out. The problem is, not everyone can buy a property to live in, so there is more demand for rental properties and actually less available. So actually, that you have to have both, don't you? And what they say on the radio this morning, there are 11 houses for sale in Wanaka under Kiwi Build, and they had 7 applications. And somewhere out of New Plymouth, they've got whatever number, but they're on average, the market value of an average house in this area is 189,000, and the Kiwi Build ones are like 150 more than that. You say, well, that doesn't quite make sense, does it? So at a certain point, actually as a landlord, strategically, this might be a really good time to buy and to hold, because rents have to go up. This is supply and demand, means that they're actually going to be more sought after. Now it's possible they had a thing called the they still have FIF rules, Foreign Investment Fund, relating to dividends on overseas shares and super funds and life insurance policies. And up to, I think 2007 maybe, they were done on a particular basis. And if you made a loss, you had to carry it forward. They decided to change the rules totally, and at that point they said whatever loss you've got carried forward, you can write it off in 2008. So a change of government could say we don't like this and we're going to scrap it, and if you do have a loss carried forward, we're going to allow you to write it off in some way, either in one big lump sum, or back in 1982 or 1990, you can apply it over a period. But you have to say, once things get into the Tax Act, they're a little bit hard to get out. Let's say any of these, it doesn't matter whether the entity is a trust or a look-through company.
Yeah, that's what I thought.
It's actually, they look at that activity within the trust. So if it in a trust, so it doesn't, the owner of it isn't going to make any difference to the outcome.
Yeah.
It's only if you can juggle things around a bit, do some costs now rather than later,
Yeah.
juggle the borrowings between the LTC or the trust and another business entity, that could work. But you're right, if you're going to own rental properties, LTC is a good way to do that for the longer term, even if you have to carry the loss forward, because the trust would also have to do the same. No, there's no downside, and I actually say there's a cost efficiency, because adding another property into an existing entity, it's just the infrastructure is already there to be the same under current tax rates. But you could also look at that point, say, is this still the right ownership? Should we now say, right, it's going to be positive going forward, should we eliminate an entity and move that into, the ownership into the family trust? Or else just leave it like it is,
Yeah.
because it's easy.